Hello everybody, what's going on? Few important updates are coming from news, and today I have got some key insights directly from Nio CFO Stanley Koo that gives us a crystal clear look at their strategy for the fourth quarter and first quarter of the next year. So let's break this down, what he said and why it is spell an incredibly positive picture for Neo's future. First, let's talk about the bigger number in the question: potential 18% gross margin in the fourth quarter. When asked by an analyst about what gross profit would look like with an 18% margin in Q4, Mr. Koo pointed directly to two key drivers for this margin expansion. First, higher margin products. The continuous ramp up of higher margin products like the ES6, EC6 and the flagship ES8, which is fully ramped in fourth quarter, the mix shift is absolutely critical here. Second thing is cost optimization. He also highlighted the contribution from increased sales in other segments like parts, accessories, and aftermarket services, which often carry relatively higher margins, along with ongoing cost reduction and efficiency improvement. In fact, Stanley Koo has even stated in the past that the long-term goal for the core Neo brand is to progress from 20% towards 25%. Hitting an 18% overall margin in the fourth quarter would be a massive milestone, a huge jump from 11.7% reported in the fourth quarter last year. This isn't just theory. We have seen this momentum build, with the company recent gross margin showing steady sequential improvement. When asked about first quarter gross margin, he said that we know the EV market often sees a seasonal dip in the first quarter due to the holiday factor. He also confirmed that Q1 is historically the low season for the automotive industry. So if they hit that strong 18% in the fourth quarter, Q1 margin will naturally be lower quarter over quarter. But here's the crucial point. He also stated that Q1 gross margin outlook will be better than the gross margin they had last fourth quarter. This is the key investors. It shows a fundamental structural improvement in Neo's business. Even with expected seasonal headwinds, the cost structure and the product mix are so much healthier than a year ago that they are holding a higher margin floor. The product structure with contribution of those higher margin vehicles is becoming more stable now. This isn't just about small percentage point, it's about the entire investment thesis for Neo. First, it offers clear path to profitability. Achieving and maintaining these higher gross margin is single most critical step on the path to becoming non-GAAP profitable, which the company is targeting. Every percentage point gained here has amplified effect on the bottom line. Second thing is investors' confidence. As the company delivers on margin improvement, we are seeing analysts get more bullish. Price targets are moving up, reflecting confidence in the company's ability to execute on cost control and premium product strategy. Third, multi-brand strategy. Let's not forget new brand Onvo. Nio CFO has outlined that the Onvo brand is targeted to maintain about 15% vehicle gross margin. This means that the new mass market brand is designed to be immediately accretive to profitability, not a margin drag. Here I have no doubt Nio is executing. They are making the necessary structural changes. Their product mix is favoring higher margin models and their cost efficiency is kicking in. The journey to profitability is a marathon, not a sprint. But based on CFO's comment, the vehicle is absolutely picking up the speed. The market often focuses only on the headline numbers, but the real story is in trend. Stanley Koo's commentary confirms a clear positive margin trajectory, showing that the seasonal weakness of Q1 won't erase the permanent operational gains made in the fourth quarter. If they can hit that 18% target in the fourth quarter and then hold a structural higher Q1 margin, the market will re-rate the stock. The potential upside, as flagged by several major investment banks, is significant. So keep your eyes on those margin reports because the transition from growth company to profitable growth company is well underway. With that said, thank you so much for being here. See you in next one.